Hey there, community bankers. Welcome back to the Correspondent podcast. I'm your host, Madison Kaplinger, Marketing Associate for ICBB, and today we're bringing you a very special episode of the Correspondent because it was recorded live from our 2023 Annual Credit Conference. We hosted a panel discussion on loan review and risk management with our CEO, Derek Hetherington, Professor Maggie Abney from Eastern Kentucky University, and Don McFadden and Matt Evans from our affiliate Bankers Service Corporation. Hosting the podcast live was a wonderful experience, and I hope you get as much enjoyment out of listening to it as we did recording it. And if you weren't able to attend our credit conference this year, we hope to see you next year. Without further ado, here's the live recording. Hey there, community bankers, and welcome to a live recording of the Correspondent podcast. As Derek said, I'm your host, Madison Kaplinger, and I'm here with my co-host, Derek, our CEO. And we're so excited to have you all be part of our podcast today. We've got a panel with Don McFadden and Matt Evans from Bankers Service Corporation, Maggie Abney from the Matt Evans Banking and Financial Services Program at EKU. Go Colonels. And we're going to be talking about all things credit risk management, loan review, CECL, ALM, and time permitting, we'll be taking your questions as well. So you might get to hear yourself on the Correspondent. So to get started, why don't each of you, our panelists, introduce yourselves to our audience. Tell us a little bit about your institution and what you do. Matt, would you like to start us off?
Sure. Good morning or afternoon. And I apologize. Is anybody else having allergy issues? Yes, I know you all are. So I've waited a little late on the Flonase. Just went to Costco and bought 365 Zyrtecs to start taking. And now I find out that Xyzal is the way to go. So the 365 Zyrtecs are probably going to be 364 plus 365 Xyzal. But if I start coughing or sneezing, I do apologize. Nothing I can do about that. We are so excited to be here today. We appreciate Derek asking us to join in on this. We feel very comfortable talking to you all in a very informal format about what we are seeing on our loan reviews, our loan compliance audits, our loan internal audits. So really anything is fair game. I'm not going to give the same disclaimer that the feds give about these are the opinions of Bankers Service Corporation, but now I will disclaim we are not lawyers or attorneys. We are not economists, although we'll probably talk a little bit about interest rates. So anyway, I think all questions are fair game. Again, we are able to go back and forth. This is not going to be a formal presentation. Happy to take questions. I am very fortunate to have Don McFadden, who is a very seasoned, I think all of you all know Don. Don had an entire career at the Kentucky Department of Financial Institutions before we were lucky enough at BSC to nab Don right out of the workforce. I don't even think you got a day off, did you?
Well, maybe a week or two.
His wife has let me know that was not very nice of me to do that. But very fortunate to have Don and his many, many years of experience, not only as the regulator, but now as a senior consultant, bringing that regulatory expertise to our clients. So just cannot, irreplaceable is the word that I use. And then when we were thinking about who else might round out this panel, I thought about Maggie Abney. Maggie Abney is not only one of my best friends, but probably one of the smartest and most articulate people I know. And Maggie has helped create this incredible vision about how we create the new generation of bankers. So Maggie heads up the banking program at EKU. There's a lot of things going on there. I'd also like to welcome our 3 VIPs of the room. There are 3 students who are in the banking program at EKU. So you're literally looking at the future of banking in this state. And Maggie's going to talk a lot about that. So as you can see, we have a lot of flexibility in the agenda today. We're going to be talking about loans. We're also going to be talking about some hot topics. Now, this may have been even more valuable if we had already had the regulatory forums before this, because we could tell you what they said, But that's coming up very soon. We've got some of those regulatory, the summer is the time for putting the regulators on the spot, which we will do. But we're happy to be here today and kind of give you insight of what we're seeing. I don't want to jump the shark here, but it's incredible that we have students who are learning about bank failures in real time. That's been kind of this myth out there. What is a bank failure? We don't even really know what that is. Add to that the second largest bank failure in the history has happened, so that's very timely. We'll talk a little bit about that. You can't help talk about lending and credit culture without talking about bank failures, although lending is not what has caused these. We'll get into that. But I thought we would jump right into it. My bio is went to EKU, finance degree, went straight to work for the FDIC at during the S&L bailout, helped form Bankers Service Corporation, and here we are today. Don, I'll let you give a little bio, Maggie, a little bio, and then we'll jump right into content.
Well, you gave me a good one. I retired bank examiner, started working for you. And so it sounded much better when you did it.
Yeah.
But that you covered it all. There it is.
Maggie, why don't you tell us a little bit about yourself?
Sure. Maggie Abney. I am grateful for the wonderful introduction that Matt gave me, and I'm honored to be sitting up here with these wonderful people and to be sharing this time with everyone in the room. It's a great crowd here today. I am a finance professor at Eastern Kentucky University. I'm an executive in residence, which means that I was a banker before I became a finance professor. And I'm also the director of the Evans Banking and Financial Services program at Eastern Kentucky University. And when I came to the university, I had just left the banking industry and I was starting to teach finance classes. I was working with these amazing young students. And I was looking at these students, interacting with these students, and the community banker in me was thinking, these could all be future community bankers because they have all the same values that community bankers have. The students at EKU, most of them are there's 40% are first generation students. Most of them are from Kentucky, the majority of them. And they truly care about making Kentucky a better place, which is exactly what we do in the community banking industry in Kentucky. And so we did a little bit of research, and what we found in this research, we researched our alumni. How many people in the room are EKU alumni? Quite a few. So what we realized is there were a lot of graduates from the College of Business at EKU that were becoming bankers, yet at the time that I came to the university, there wasn't even a class on banking. There were finance classes, a lot of them because academia tends to focus more on investments and the stock market and investment banking, because those are the things that sound very exciting to students, to young people, because that's what they see most in the headlines, right, in the media. So we started exploring this and found there was a very high percentage of our graduates that were working in the banking industry, but they were not intentional bankers. They weren't planning on becoming a banker when they were an undergraduate student. They had no plan, probably, right? Like most of us, I wasn't planning on becoming a banker. When I became a banker, I was an accidental banker, is what we call that. Yeah. How many people in the room are accidental bankers? Okay, almost everyone. So you have accidental bankers, but then you have some intentional bankers. Those are people who knew when they were young that they wanted to be a banker. How many intentional bankers are in the room? None? Okay, there's an intentional banker. There are a couple, and a lot of times that's generational bankers, right? Your family was in banking. No? So, and some people just know they want to be a banker. And so what we are trying to do is create the future of the community banking industry and the larger banking industry. Our students don't all work in community banking, but we're trying to help prepare them as well as you can prepare them. And they're taking classes on economics, on banking and the bank balance sheet, and they have a very strong understanding of these concepts before they enter into the workforce. We are fortunate to have connections with banks that are recruiting directly from us, with federal government agencies, with firms like ICBB, banks like ICBB, that are recruiting from us and hiring our students. And it is wonderful to see these students hit the ground running as young professionals, instead of starting out not really understanding banking and having to go through those learning curves at the beginning of their career. They're much stronger. So we hope to make an impact on the banking industry by doing this. And so that's the introduction I wanted to share with you, just to give you some background on what I do. Credit is not my area of expertise. We hire an expert in credit analysis to teach our class on credit analysis, and our students actually graduate. All of the students in our banking program graduate with a certification in credit essentials. So they are certified in the basics of credit analysis. Every graduate of our banking program has that certification. So just wanted to share a few of those things with you as you think about the future of your bank and your needs.
That's so exciting, Maggie. I'm so glad that you're able to build that program up at EKU.
One of the things that I'll add to that, Maggie is running a program at EKU. In full disclosure, I graduated from Western Kentucky University. And Hilltoppers in the room? Yeah, I can see. Yeah. But I actually sit on the advisory board now at EKU's banking school, just for the fact that we have in our own bank hired over the last several years several of the graduates from her program. I think we currently have 7 of our staff members actually came out of the EKU banking school, and they come in with a much higher understanding of what we're looking for new, young people coming out of college to be able to hire and have a better understanding what we're looking for staffing. So actually our host is from a graduate of EKU on the marketing side.
Yep. So
we actually have a really strong partnership now with EKU. I'll have to wear the other kind of red. I can't get into the crimson yet, but I do appreciate everything that they're doing for us as an institution in banking. And we just wanted to kind of highlight that a little bit today in our podcast. And obviously, with the expertise we have here, we can cover a lot, but in a short time frame, what we want to really kind of do is dig into a few things. Being a credit conference, it'll really impact you all, and hopefully we'll take you guys away with some ideas and stuff on different things you need to be looking at and different ways that you guys can start looking at the future needs of your bank when it comes to asset quality, staffing those different areas of your bank, and being prepared for your audits and exams as they come up over the next couple of years. And then Matt mentioned a little bit about BSC. One thing I want to he's a little humble in it. BSC was actually started by community banks. So it is an audit firm that helps community banks, formed by community banks. Matt Evans had the opportunity to basically, make that his own, and he's grown it, expanded it throughout kind of the footprint of Kentucky and the surrounding area. Don is one of several staff members that he has that are former regulators that have come on board with them that have that kind of mindset of, what you need as a bank from a loan review or compliance audit. What are the regulators looking for? Well, what better than a regulator to come in there and look at it, but not come in as a regulator or an auditor, but as a partner. So you can kind of start to identify those things and then kind of have a course of action to correct those before your exam starts. So I know BSC has been a great partner for us, and I know several of you probably use BSC in some capacity. But the expertise that they have, that's what kind of differentiates them from the CPA firms and some of the other firms that create, a product or service to offer those type of audits. You're going to really get a firsthand, understanding of what you need to be looking at from an auditor's perspective. And you did mention some of the services you guys offer. I know that one of the things that I'd like to kind of touch on early is, like the loan review process. I know all of us are sitting here, with a exam on the future radar. The loan review is a great process right now when we're looking, asset quality. I know in one of our earlier sessions today, they talked about past due payments is not an early sign of trouble. So the loan review process, I feel like for us, is we kind of use that as a way to be able to kind of have fresh eyes looking at our credits to make sure we're looking at everything that we need to be looking at to try to identify those early risks within the portfolio. I know you guys conduct several loan reviews for community banks around the area. So, Don, I know from your experience, is there anything right now that you're really seeing that maybe the rest of the bankers in the room or that's listening to this podcast should be aware of?
No. Actually, the credit quality that we see right now across the banks that we're engaged with is fairly good. And so, the potential recession, the inflation, that's creeping up, and that could have impacts going forward. But right now, we're seeing good asset quality. We're not seeing less than satisfactory asset quality. So in general, most of the banks, and we're coming off a long period of time where there's been low rates, and so that's to be expected. And so the higher rates are creeping in, and they've just started. And so your problems very well could be maturing right now. And so, but we're not seeing anything out of the ordinary, thus far.
So you did mention interest rates. I know that that's something that's on everybody's radar, especially when you think about, looking at cash flow projections. I know we all have some kind of rate shock built into our, analysis on the front end. But, even an aggressive 3 to 4% rate shock, we're living that now. So when you start looking at those loans now, they're getting ready to come out of that repricing into the new rates. Is there anything that you would recommend that banks start looking at as far as doing their own annual reviews?
Right. Well, just pay close attention to your rate shocks. That'll give you the warning that trouble might be on the horizon. There could be a negative trend as a result of that. You might have one specific loan with one specific stream of cash flows that the rate shock impacts. But then from a global perspective, how does that factor in? So the rate shocks will give you a signal. It'll give you a warning signal if it's turning into a less than satisfactory debt service coverage ratio. And so you just need to be aware of that. You need to monitor that closely and report that and with regard to the rate shocks.
I've got a question. And BSC is doing a big penetration of banks in the state of Kentucky. We have a lot of Kentucky banks, so we are in a position to make some broad statements. Don, of our clients, how many banks are doing rate shock analysis at their annual reviews on their largest credits? A high percentage? I'm not asking for...
It would be a high percentage of folks doing rate shocks. And, we don't want to say everyone that's not doing a rate shock, raise your hand. But the rate shocks should be out there, and you should be doing them. And there'll be indicators, that there could be potential stress within the portfolio. And so that's one indicator that, you could use the rate shock and monitor that closely. And so I don't know if that, factors into some projects, the rising interest rates, that there'll be some projects maybe that have been approved that have not yet started. And maybe the construction projects or other loans that have been approved, but they have not moved forward. And so the interest rates could impact those. Of course, the overall cost, the inflation cost could also impact loans of that type as well. And so loans that haven't actually started into what they were approved for, that could be a potential warning indicator as well.
Even for our smallest community banks, would you recommend that they do some rate shock analysis on their largest borrowers?
Yeah, I would do that because that's an indicator. It's a warning indicator. It'll give you an idea. And, rates have gone up this year. And so I don't know if anybody's done a 500 basis point rate shock, but the rate shocks will give you indicators. That's always a good warning signal to have.
Derek, we just did a podcast with Alan North from the Federal Reserve, St. Louis. He talked about rate shocks. Was he talking 500 basis points, or what was he? I'm trying to remember. At least 300, right?
Well, it was his opinion, not the opinion of the St.
Well,
Louis
there we
Fed,
go.
correct? So, but I do remember Alan saying that if we do rate shocks, we're probably just not doing enough in this environment. So that it's kind of like when you're looking at your back testing of your ALM. You always have rate shocks, but this has been one of the more aggressive rate environments that we've been in as far as Federal Reserve's policy on increasing interest rates. So I think that from his kind of opinion, our opinion that we kind of discussed in that podcast was the idea that a rate shock is important, but obviously at this point people feel like we're at the top of the interest rate curve. But if you got gray hair like us, you kind of remember that this is normal interest rates. Some of the younger and some of those coming into banking in the last 10 years, they've never seen interest rates, at this level. But, if you look historically, 5-6%, interest rates are, pretty standard across history. So, how long is this going to hold? I think you need to prepare for interest rates not to go back down. I think the 0.25% increase yesterday was a clear indication that the Fed's not going to back off. until they get inflation down to that 2% range. And with the employment and everything else it's indicating right now, the economy is pretty stubborn to back off even with the higher costs. So I know the interest rate shocks, that's kind of the big topic right now. I mean, because you're looking at how much interest rates have increased over the last 9 months. You're looking at the continued policy and standard of the Federal Reserve Bank to continue to increase those until they can get that inflation in check. So, interest rate shocks, I think, are a good way to kind of find is there weaknesses that you need to be aware of in the cash flows that maybe strong cash flow when you originated the credit. How is that being impacted now at the new current market interest rates? But other than just kind of doing rate shocks, is there anything else that you're seeing, especially when you kind of think about those tough findings, like the regulatory findings and stuff like that? Are you seeing any uptick or any changes in, the reviews you're doing as far as, regulatory findings that you're seeing?
Well, we will see some LTV exceptions out there that haven't been identified. We see some of those, and that's low-hanging fruit for the regulators to come in and find one of those. And so you just need to be aware of that, but it's not too critical. But you just need to aggregate those and put them in your report and monitor them. You don't want to have too many exceptions that the regulators find that you haven't already found. And so that's, I guess, you need to be aware of that. And concentrations, you need to take a close look at your concentrations, make sure you're monitoring that adequately. And if you have any concentrations over the 100% limitations or over the 300% limitations, you just want to make sure you have strong reporting on that, strong monitoring on that aspect of it, because that would be a negative finding. You just don't want the regulators to come back to you and say you need to do a little bit better. So you need to have good, strong monitoring on concentrations, especially if you're over those limits. And if you are over those limits, it's not a bad thing, but you just need to maybe strengthen them. Segregate your commercial real estate into types. Make sure you got the hotel loans broken out. You know where you stand with those. If you have construction going on, how much of that is spec construction? How much of that is contract construction? It makes a difference. It makes a risk management difference as well. And so, the current level of construction is what, and the total unfunded amount is whatever that is. And then that way you're showing the regulators you've got a strong handle on these concentrations, and you're managing them even though they are over the recommended levels. I always watch the growth too, growth limitation.
I'd like to add to that. Dawn and I we've been talking about this all morning, talking about having a strong handle. We think, and we recommend, now's the time, while things are still good. I'm not saying that they're not going to be good, but now's the time where you nail down that loan policy. Now's the time to go back through it with a fine-tooth comb. Now is the time to revisit your appraisal processes, your appraisal review processes. Just get all your ducks in a row, because in the event when things do or could start to deteriorate, regulators instinctively are going to go for the low-hanging fruit. They look for appraisal violations. They look for LTV exceptions. They look for supervisory guideline issues. They look for the technical type things to start whittling away at your loan portfolio. So in good times and strong times, it's time to get all the housekeeping in order. Your committee structure needs to be sound. Everything needs to be approved according to policy. So now is housekeeping time for times that may be a little rougher down the road. And how many cycles have we been through with this, Don? We've seen it over and over again. The regulators are and there are no regulators in here, they're very predictable in the way that they do things. So, and that's not an insult, it's just a heads up. Be ahead of the questions that are going to come. And I've talked to several people who are having exams this spring. I mean, they're coming. So I feel like our clients tend to move in cycles where several of them are having exams at the same time. We are having a lot of safety and soundness exams coming. But good, clean housekeeping is always a good idea.
You mentioned the LTV issue. I think, do you believe that was a result of maybe, really soft, credit cycle we've had over 10 years, a lot of competition for loans, people kind of maybe making exceptions on what they would traditionally view as being max LTVs that's led to that, or is it more?
But, it's not bad to have an LTV exception. And so, but you just need to, track it, monitor it, and make sure the exceptions are out there. You know of them. They're in the right bucket, and you report those. And so it's not bad to have them, but you just need to be aware of them. You need to report them. They need to be sent up to the board for at least a quarterly review. So,
one of the things that we've seen as far as doing like our annual reviews is, it seems like more and more businesses are doing extensions on their tax returns. So getting more updated financial information in a more timely fashion seems to be becoming more and more difficult. Are you seeing that more technical exceptions in your guys' loan reviews?
It kind of ebbs and flows with the financials. Of course, you need current financials in order to adequately analyze the borrower. So they need to be current. And a lot of times they will file an extension, and so you need to have that extension with you in the file, just as a good housekeeping measure. But in general, the businesses will start to flow in November, and so. But it's always good to have interims. You can have interims. Get a 12/31 year ending, and they can send that to you. They probably have those, and so that helps. That'll be exactly. It can be useful. So you can get an idea of where they are before you get the tax return or the audited financials. And so it's good to have those. They come and they go, and different banks have different methodologies and procedures, maybe culture. And so we go into some banks that try, they have real low level of exceptions. Others have higher levels. And so, and your borrowers sometimes get used to that, and it's hard to train them to turn them in. And some guys just won't do it. I mean, they won't turn them in, and so that can be a problem. But interims help, if you can get those.
I'd like to add to that a little bit too, in terms of exceptions and technical exceptions. It makes me think about electronic loan files. I mean, as we have moved into primarily an electronic environment, your exams are mostly happening remotely. A lot of our loan reviews and audits are happening remotely. Remember, garbage in, garbage out. Your loan files need to be clean. Examiners and auditors make very quick judgments on the quality of your loan portfolio by the electronic files that they're looking at. So if your loan files are confusing, it's human nature for examiners and auditors to be confused by your loan files, and you don't want them going down that road of making quick judgment calls on a disorganized looking electronic file. So it is our opinion it's worth your time to scrub those files, to make sure those files make sense, that they flow logically, that as much is in there as possible. Of course, you're going to have a few exceptions that pop out. We find that all the time. But the easier your story reads, the easier those loan files are to interpret, the smoother it's going to go for a secondary or a third review. So it's in your best interest for those loan files, particularly the electronic loan files, to make sense.
That's a good point. And sometimes with your electronic loan files, a document can get lost forever. It's not the file in front of it or the file behind it. It's been filed electronically and it's gone. Because every now and then we'll come across stray files or stray financial statements or documents that are in this file that have no relation to that file. And so, as you progress into the electronic file age and as you progress into the off-site exams or off-site audits or off-site reviews, tightening up the loan files, that's an excellent point. That's a good thing to be aware of. And and work on as you go forward.
Well, if banks are kind of looking at their kind of risk assessments, trying to determine what kind of scope they should do to make sure that they're covering the amount of the loans or the potential risk within their portfolios. Do you guys have any recommendations on what they should be taking into consideration with regards to a scope of loan review?
Yeah. I'd feel free to mix it up. So you got your loan scope, and a lot of times it's we're trying to hit the highest volume of risk that you have on the portfolio. But every now and then you might want to mix that up and, focus on a segment of the portfolio. Do you want to focus on, maybe construction, or if you have hotels, maybe focus on those all at one time, or look at construction policies and procedures. Even a loan officer, focus on the new guy, see how he's doing, make sure he's doing it right, And so that's always a good thing, and we found that to be productive when you focus on different individuals. Not all the time that's needed, but sometimes it is. And it can be a productive review. So mix up your scope.
And another thing, don't be afraid. If you just had an exam, the examiners give very good suggestions. You may want to mix up your pre-existing loan review scope based on your most recent exam, and just ask your examiners: are there other areas that we need to include in our loan review scope? Because I think that your loan review firm should be able to change that on the fly. Make some tweaks to your scope as you go to make sure you're getting a good look at the portfolio. Yeah,
and we can bend with it when we come in. You can have if we say, "How's everything going? Do you have anything you want us to look at?" It can be a loan that might not be on the scope, or a set of loans that are not on there. And so, feel free to make suggestions, because, we can bend with it when we come in. I'm sure everybody else can too.
One thing we're hearing from banks is that they're struggling to find skilled, seasoned credit analysts. Do you guys see that as an issue for community banks, and do you feel like it's impacting asset quality, or at least portfolio management of it?
Well, that's a skilled position that you need to have, and sometimes it can be difficult if you have your credit analyst leave. And so, because your options are limited, you either have to go out and find one, and it depends on where your bank is with respect to the employment market, whether or not that's a easy task or a hard task. But you can train from internally. You can train somebody, but that's hard. But sometimes we'll see transitions with the credit analysts. They'll transition in and out. And it's a critical position, and sometimes it's difficult to replace.
So I want you three to listen. One of the most marketable positions in the bank is to start out as a credit analyst. I get a call at least once a month from a bank looking for a credit analyst. Do you know of anybody? No, I don't. That is short next to the compliance officer position, which that's impossible to find. Credit analyst, it's an excellent career choice. So yeah, we get a lot of requests for that.
It is. And it's one of the things that as a university we are trying to assist the community with. And we're still in the stage of trying to figure out the right way to do that, because you don't need a credit analyst until you need a credit analyst, right? And then you really need a credit analyst. But there aren't a lot of them floating out there that are seasoned. And so we're trying to work with community banks for feedback and ideas on how the banking program at EKU can work more with community banks on perhaps, I don't know if maybe it is a form of succession planning. Can you have a junior credit analyst on staff that is there in case you have a gap in your higher level credit analysts? How do we keep banks from having this situation? We're trying to create future talent right now, but the entry-level talent needs a place to go. And so we would love to see more banks that are doing internships in the credit department for our entry-level talent, because they're very well trained on the academic side. They need some industry experience to go along with that. And I think most banks will find that they really want to hire these students after they've worked with them and they understand the culture of our students at EKU, because it is a perfect fit for community banks. And the other thing I do want to say is the banking program at EKU is advised by a group of people who keep everything current with current industry needs. And so we have a wonderful advisory board who Matt Evans is the chair of it, and Derek Hetherington serves on this advisory board, and they provide us with feedback where we constantly update the curriculum and try to prepare our students for the current needs of industry. And so the next form of feedback that we would seek is, I would love to hear from anyone in the room about how we can help you solve that issue of filling the gap when you have a need for a credit analyst. We don't feel like we have really solved that, and we don't feel like, we have entry-level talent. We need you to help us. We need help figuring out how to get them from that entry-level to that mid-level talent. And I think internships might be the answer. So if any of your banks are interested in this internship opportunities, we have lots of students that could fill those.
I mean, I know when I started with the FDIC, we had a series of 4 schools we went to, and the RMA credit analysis course was, I think, the part of the 4th school. It's one of the most informative things I've done. And the fact that now students are doing that, I would have given anything if I could have done that my senior year at EKU. But so I think there's a huge demand for that. It's some of the best content that I got as an examiner. So you're definitely on the right foot.
Maggie, I appreciate you plugging the need for entry-level talent, because I remember being entry-level talent, and that was rough. So
it is difficult. But in the community banking industry, there is support out there for it. And we're really just working on building that structure and that relationship between our academic program and the community banking industry. And we really want to get the word out there that we want to help with entry-level needs. And entry-level doesn't always mean being a teller, right? Because our graduates have a college degree, and when they graduate, at that point, they are suddenly eligible for all these other jobs out there. So what we'd like to do is place them, if entry-level for community banks is a teller position, we'd like to place them as a teller while they're still a student, say sophomore year, and allow them to kind of get a feel for all the areas of the bank, feel for what is the best fit for their personality. And then by the time they're a senior, hopefully they're ready to move into like a junior credit analyst role, right? But they've already gotten immersed into the culture of the bank, and the bank has seen the culture of the student and that it's going to be a good fit before that full-time position is offered or created. It also gives the bank a few years of planning time. So another thing to do is, if your bank has tellers that are currently working for it that are students at a university, get to know those tellers. They are going to graduate, and a lot of those students are not going to stay working as a teller. So if the bank has not keyed into this and started creating a relationship with the student for, hey, what do you want to do when you graduate? Do you have any interest in staying with our bank? If so, have you thought about credit analysis? And if they're an EKU student in the banking program, I can tell you that they've definitely thought about credit analysis. They're going to be certified in credit analysis, and they would love to have a career that begins as a junior credit analyst. And our students are wonderful. They don't mind working as a teller and learning the bank from the ground up, but they would prefer to start that teller position while they are students instead of after they graduate. And that's kind of the trajectory that we're trying to help set. And so I would love feedback. I would love connections with anyone that's here today. If your bank has any needs for tellers or junior credit analysts, we would like to plan that, sit down and make a plan for your bank.
And I'll just kind of echo what you said about identifying the young talent that's sitting in your teller station. I actually started off as a floating teller when I was in college. Started applying for positions within the bank leading up to my graduation from college, and wasn't even getting looked at for consideration for office managers positions or assistant branch manager type role or branch manager roles that were coming up. And so I started looking outside. And when I put in my resignation, everybody freaked out. Like, we didn't realize you were going to leave. It's like, well, I'm graduating. I need to be full time. I can't work part time anymore. So, it's one of those things where I think that there's, graduating students are, if you've got somebody who's good talent sitting in a position entry level within your bank going to college, definitely I would be keeping them on the radar. What are their plans? What are they looking at? What's their timeline? Making sure you can find a place to fit them into your organization if you want to retain them. So
they are most likely a hidden gem. And one of the things, I study a lot of bank innovation and the culture within banks and how it evolved over time and why. And one of the things that, part of being more innovative and being able to compete in this intense, environment where technology is rapidly progressing things and fintechs are these shiny, things that seem so exciting. But I'm a believer in community banks and the community banking model. And I believe that community banks, are going to be here forever, and they're going to be the foundation of our economy. They're so important. And so one of the issues, especially if you're in a smaller bank, is the timing of when you need young talent and trying to do succession planning for that lowest level, entry level talent. It's really, really difficult to find a way to set your resources to focus on that. And so one of the more innovative things now is trying to plan ahead 2 or 3 years for some of those entry level positions. Look further in advance and start getting some tellers from EKU's banking program so that in 2 or 3 years when they graduate, that timing is right so that you can offer them that full-time position.
Speaking of planning ahead, you've all been planning ahead for quite some time, and guess what popped up this year? CECL.
Yeah,
so we're deep into CECL validating at this point. We can give you Don can give you a few kind of pointers of what we're seeing so far. That was not the best segue, was it? But
I thought it was great.
It worked. But so we're looking at some various different CECL models and the processes. And so we've seen some banks that are doing it all their own. Most everyone has some type of program that they're using. And so you can't really validate whether or not that's good or bad until after you've had maybe a year's worth of activity to see if the CECL is adequately reserving for your credit risk. And so, but, what we'll look at when we look at your process is what goes in and then what generally comes out. We don't look at the program itself and see how it operates, but, they probably have a validation themselves. So, like Bank Trends, Plan Smith, or the others out there, whatever name or software package they are, they will have a validation themselves that will be conducted by a company that's available to, I would imagine, all their subscribers. But we'll look at what's going in. We'll look at the activity that the board has had, the input that they've had, monitoring that process. We'll look at that. You need to make sure that everything is mapped correctly. That's an important part. Because sometimes if you have incorrect mapping, that could skew the data that's coming out. And so we need to make sure that the mapping's there, the data is there. There are other metrics out there that you can control. Some banks are finding that they don't have enough in the reserve after the calculation. Some banks are finding they have too much in there. And so I don't know if I would ever say too much. I might say that it's not inadequate. I don't want to say it's overfunded. I don't like to say that, but I don't know how that will be reviewed from a regulatory perspective. That's to be seen. But, if you look back over the course of a few prior years, if you haven't been criticized over your reserve in the last several years, And there's no reason to believe that the level that it's at right now is inadequate. And so, I know the CECL methodology is new, and so it'll take a while for it to go through an exam cycle or two. And so I would imagine the examiners will come in, and if they see something they don't like, they'll tell you about it. But it won't be a major finding. But if they come back, you haven't done anything, and then that's when the pushback might start happening. But it's new to everybody. It's new to BSC. It's new to the accounting firms. It's new to the examiners. It's new to the banks. And so, but you want to make sure the data going in is good, and then that helps on the data that comes out. I don't really want to say garbage in, garbage out. But if you've got incorrect data, if you've got a certain loan pool that's maybe mapped wrong, and it's in a segment of the portfolio that has a higher loss history, well, it'll generate a higher required balance for your CECL. So you got to be careful about that. You want to look at that. Then the qualitative factors and environmental factors. The guidance that is out there, that the joint interagency guidance out there, the metrics that they have in there are still valid. So those metrics are still valid. So if you've got your own personal metrics in there, they might not be as forward-looking, but the regulators have expressed an opinion that the metrics that they have within the regulatory guidance, the interagency guidance, are valid. So if you use those and, try to allocate the risk within your portfolio sprayed amongst those metrics, then that's how you could better quantify the risk in the portfolio. So you can increase or decrease the balance, relative to your portfolio. You've got to get an explanation and a justification of why, for that particular metric that you're using, that you've got like a 5% allocation or a 0.25% allocation. You've got to get a synopsis in there. It probably doesn't have to be too in-depth, but it has to be straight and to the point, and it needs to make sense to everybody. But I think that's one of the critical parts of the current CECL is the qualitative or environmental factors. And so if you got those down, then you can kind of finesse, the individual portfolio risk, depending on the economy, your local economy, or you might have a higher metric for that, and so you want to be aware of that. And your policy, the policies have to change a little bit to tie to the CECL methodology. And so just be aware of that. Your policy has to tie to that. And then a weird part, something new, is the reserve for your unfunded liabilities. And so what's that? And so you've got to get that on your liability side. And that's the requirement, that you have to fund the reserve for your unfunded liabilities. And so that one's hard to nail down, exactly how to do that. But, say your HELOCs, do you finance 100% of your HELOCs? Generally, if it's 50%, then okay. Then 50% of your unfunded might potentially be funded. And then you can allocate your risk factor to that. That's on your liability side. You've got to be aware of your held-to-maturity securities as well. And they need to be accounted for with CECL. And so that's another aspect that hasn't always been out there. And so, but those are the two, I guess, weird things with CECL on that.
Well, I know CECL is just one of the many factors we're seeing, when you look at interest rates, just kind of overall tightening of liquidity in the market, these new CECL reserves on some of the, unrecognized risk within our credit portfolios and our balance sheet. it's really putting a lot of pressure on cost of funds and interest rate margins. Are you seeing any trends in the market that are concerning with regards to banks maybe increasing their risk appetite for higher yield loans or?
No, as far as using the requirements of CECL and the change in interest rates to stretch or reach out for higher yielding loans, we aren't necessarily seeing that. It's just normal course of business, within the marketplace and within your market area. We aren't seeing people that are trying to extend that out beyond where they already are, beyond the footprint that they have now, in order to compensate for some of this. We aren't seeing that type. Lending's kind of, with the interest rates going up now, you can be kind of selective on who you want to, any new business, any new borrowers. With the higher rates, you can be selective on that. And loan demand has declined a little bit anyway. So,
I think with the higher interest rates, I would kind of anticipate that we'll see a cooling off on the lending. Obviously the impact that has on net operating income when it comes to looking at appraisal valuations, cash flow abilities. I think that the Fed achieves what they're hoping to slow down the economy. Increasing interest rates should see a decrease in loan activity. Yeah. Is there anything else on the radar that the banks should be looking at? Whether it be from credit risk or just from overall asset liability management that you guys are seeing that it's like, hey, just.
Well, the increase in the rates, can be a shock to the portfolio. And like we talked about earlier, we haven't really seen a decline in credit quality. In the banks that I've been in, we haven't seen, too much of a change with on the liquidity side. Deposits are always, nice to have more deposits, but we aren't seeing anything like they're seeing out west, like with the J.P. Morgan take over the Silicon Valley. We're not seeing anything like that. And, in the news today, they're talking about Zions Corporation is one that is feeling the impact from that. PacWest, Western Alliance. So, I think that's localized to some of those larger. And it would appear that those guys really didn't manage their asset liability as best as they could have. And, in talking with David, Cole, doing the back testing with us, that, he's saying it's a little bit more of a challenge to do the back testing in this environment, but he's not seeing too many problems in that area.
Yeah, it's amazing how you look at the bank failures that followed the last financial crisis in 08, 09, 2010 failures. It was all driven by asset quality. And if you look at the asset quality aspect of Silicon Valley and First Republic and Signature Bank, there was no indications of risk when you look at it just from that asset quality perspective. But when you start looking at their unrealized losses in their held to maturity portfolio and their increase in their non-core funding, there were some big red flags. I think that the market sensitivity obviously is going to be the biggest issue banks need to be looking at and concerned with when it comes to oversight right now, because there's still, like you said earlier, there's not really been a change in asset quality as far as seeing a drastic change in non-performing assets. It's all really been focused in those unrealized losses and how that's impacting banks' capital and liquidity positions. So.
Right. Like I said, the credit risk has been pretty good, and as you go forward and rates change and borrowers come in, they don't want to. Who wants to pay a higher rate? Nobody does. And they want the same rate. They want the same payment and the same rate. But I'd be careful about that. I would be careful about making exceptions to to the loan policy. Someone coming in wanting a lower rate and a longer maturity, that's a red flag. It's a warning signal right there, potentially, or they're just seeing if it'll stick. But I would try to curtail the risk in the portfolio. Just stick to your loan policy. Don't have too many exceptions to the loan policy, and I would monitor the exceptions you have. If you're making exceptions to loans, either at origination or during the course, I would document those, monitor them, and I would report them on up to the board as well. Let the board be aware of the exceptions that are being asked for and granted. And so, but that is one way to kind of control the risk and, within the portfolio is to limit the exceptions. You got a policy, and if it's a good policy, just stick to it. And so, we're assuming they all are. And so, but that is one way to curtail the risk.
Well, I know we've used up about all the time we have today. First off, I just want to thank you all again for participating. Obviously, the information today is, a good reminder. I think hopefully most everybody who's here is obviously very focused on, credit and credit risk management within their banks. They're trying to expand their knowledge and at least check the box that they're doing the right things within their institution. So if they didn't pick up anything new today, hopefully at least they were able to validate what they're doing currently within their organizations. Obviously, the challenges that we face as community bankers, having the resources of a banker service corporation that kind of bring in some expertise and give you kind of insight when maybe you are working with a younger credit team or a lending team, can kind of help to make sure that your teams are still doing the right things and you're not, picking up these technical exceptions and stuff like that because of just inexperience. And obviously, if resources like EKU to be able to tap into new young talent in the banking industry is something I'm very excited about and happy to partner with EKU on. So I would encourage anybody listening to this and everybody here, if you have needs, whether it be having somebody come in and do your loan review and help you with your external audit or your compliance review, or if it has something to do with just staffing and trying to find young talent to come in for your bank and your succession needs, I would encourage you to reach out to anybody we have on our panel today. But before we close, just real quickly, do anybody have any final comments that you'd just like to share with the audience today?
No.
Thank you for having me today and for allowing me to be a part of this. I've really enjoyed it.
Well, we appreciate it. And I feel like we only touched the surface on CECL and CECL validation. If anybody wants to talk to Don and me a little bit more about that, please do. There's a whole body of knowledge. The one topic we didn't get a chance to talk about that doesn't specifically hit on credit is cybersecurity. And if you poll regulators on one of the major risks in the banking industry is cybersecurity, we could literally talk all day about that. But that is a hot topic. And can we reserve a right to do a future podcast talking about cybersecurity?
We actually did one podcast recently talking about specifically with what you do in the situation of ransomware. We had a 2-part podcast about that. But I think overall just cyber and data security is definitely something we have on the radar in the future. Because there's been a major uptick, specifically around spoofing and phishing and hacking of email systems that we're hearing from community bankers from all across the footprint. And the amount of money that's being lost from fraudulent activity is getting to a size that is almost kind of shocking. So, yeah, I would completely agree with you. Future topics would definitely be something to spend some time on. So with that, I guess we don't have really anything further for today. So, Madison, I'll kick it back over to you to close us out.
Yeah. Thank you guys for being here. Thank you guys for listening. I want to thank all of our panelists for the expertise they contributed. And for those of you that are subscribed to The Correspondent, thank you. For those of you that aren't, you can listen to and subscribe to The Correspondent wherever you get your podcasts, Apple, Spotify. We're on all the major platforms. And this panel is, I think, a great example of the kind of knowledge that we're able to share with you guys as, I think, a key part of our mission to protect and promote and support the community bank model. So thank you all again for being here. We'll see you next time.
Okay. All right.
Thank you guys so much for listening, and I hope you've gotten some value from this conversation to take back to your community bank. Make sure to follow or subscribe to The Correspondent wherever you get your podcasts and turn on notifications so you never miss a new episode. See you next time.